Good morning, everybody, and welcome to today's Monday morning mortgage update. Well, we took a beating over the weekend. We have some interesting information based on Moody's and their grading of the U.S. credit. So we're going to jump right in, kind of see what rates are doing. We had a pretty good week, a couple days last week, and then, well, I'll show you what happened this week. So let me go ahead and share, and we'll get right into it. So if you can see, we had a pretty bad trajectory on the universal mortgage-backed securities on the 6% coupon. We started in early May, pretty good up here. We thought we were going to break above this Fibonacci level and go towards the moon here. And well, it didn't happen. We saw a pretty significant decline over the past few weeks. But then middle of last week, we got a surge, a big surge. We had a good day and rates rebounded, and it looked like they were going to continue on Friday. It kind of pierced above these two. Let's see, this is the 25-day moving average and the 100-day moving average. But then it bounced back down to this Fibonacci level. And then today we started out low and then we sank all the way down below here, which is on this very important Fibonacci level. We held ground. Isn't that amazing how that happens? Like it just sticks to this line and it doesn't go further. Thank God, because it would have gotten a lot worse like it did back here, went all the way down to this one. But we have rebounded a little bit. It was quite bad this morning. And then we are kind of in the middle of this range right now. So we're in a bad spot. Mortgage rates, if you kind of go back over 6 months, like they've only been lower. Mortgage rates have been worse. Let's see, 1, 2, 3, 4, just a handful of times. If you keep going way back, we saw rates improve back in September last year and then come back down. And then it's been kind of volatile, as you can tell. So when people say, what's your rate? Say, well, here's a fun chart that show where rates have been over the last year. They are all over the map and in big swings. So it's really hard to predict what rates will do, and it's kind of funky. So I want to show you guys a little bit of what's happening in the markets and why Moody's has decided to give us a AA1 rating, which is now S&P rating of AA+. AAA is where we used to be. But the reason is this: the amount of debt that we have in the United States is just mind-blowing. So we're at 123% of our GDP, the public debt is. Federal deficit is 6.4%. Look at that. I mean, compared to everyone else, we're in a pretty bad spot. So Moody's downgraded our credit rating today, and that's why we saw the sky fall, so to speak, on the mortgage-backed securities and on the 10-year. So kind of a rough day, to say the least. So let's go back to kind of where we're at today. Let's look at the 1 month. Yeah, we're kind of stuck on this. Bad trajectory here. Let's hope we can get out of this and climb out of this. Let's look at the 10-year real fast, because we're up 10. We're up 10 basis points on the 10-year, up to 455. Looks like we were at today. Yeah, wow, that was pretty high. So notice that 10-year goes up. When the 10-year goes up, mortgage rates go up. So kind of a rough week, a rough way to start the week, I should say. But let's hope we get a rebound, because it was negative on the 10-year, on the 30-year mortgage-backed securities. We were negative 30, so we've rebounded quite a bit. So let's keep our fingers crossed. Say a little prayer for these rates as we move forward. So where are rates right now? Here's a nice little breakdown of kind of where we're at. And you can see that the 30-year just below 7, but this is based on last week, ending on Friday. So based on today, you'll be probably above 7. And we are in the negative territory. Keep in mind, these rates are based on like the pristine borrower. 780 credit score, 30% down, primary residence, and these are the rates you're going to get. So if you have a borrower that doesn't have the best credit, obviously there's loan level adjustments for that, and that's where you reach out to me for a personalized rate quote. So kind of a rough way to start the week. I'm sorry I couldn't give you better news today, but rates are still okay, and I think they're going to stay in the 6 3/4 to 7 1/4 range through most of the year. There's just too much volatility and two unknowns until we get some real clarity on the different tariffs across from different countries and sorted out, and then we can let the normal markets kind of take over. It's very volatile, and this Moody's thing kind of came in from left field and kind of sucker punched us. Um, Not a good thing to have our debt or our credit rating lowered like that, but it is what it is. We have to play with it, and hopefully we will get out of this huge, I mean, 37 trillion in debt is where we're at right now. That's a big number. So we need to get out of that. We need to rip the Band-Aid off and get working on that because it's bad. And we need to get our credit rating back up. So hopefully rates will continue to behave this week. Maybe we'll see a little bit of um, a recovery. But that's where we're at today, guys. Have a wonderful week. I'll be here all week for you. Sean Woolen here with the Woolen Mortgage Team signing out.